Hi guys, a very good evening to all of you. I hope I am audible as well as visible. Please confirm if my voice is clear even without the earphones. So we are going to begin. Please give me a thumbs up if I am audible as well as visible. We shall be starting then. Sorry for the slight delay. It was because of some technical glitch. I was not able to start the class on time, but nevertheless, we are going to begin it very soon. So let's start with this very session, that is on national income. So as far as this topic is concerned, it's directly written in your RBI syllabus and thus it's very important. Good evening to all of you. Let's start. When I say national income, what is national income? It's nothing but the value of all the goods and services that are produced within an economy. So when I say goods and services, in your national income accounting, we only take into account the final goods that are there. Typically, if I talk about goods, there are three types of goods. One is your raw material, then it's your intermediary good, and the other one is your final good. When I say raw material, just giving you an example, let's take an example of a sugar cane. Sugar cane converted into sugar, and then sugar converted into, let's say, sugar is used to make some sweets. So if I take the example like this, you can easily understand one thing. Raw material in this case will be your sugar cane, intermediary will be your sugar, and final product will be your sweets. But then again there is a problem. What? Let's suppose some customer comes and asks me, I want sugar, I don't want sugar, I don't want sweets, I want sugar. In that case, sugar, because sugar is what is being purchased as the final goods produced by the customer, because customer is asking for sugar, so sugar will become my final good. All in all, to sum this up, whatever is there in the demand, if it's being directly bought, that's what I'll say as final good. So in national income accounting, I'll only take into account the final goods and services that are produced by the normal residents, that is by the residents that are living in India in an accounting period. So what is an accounting period? Accounting period typically for India is that starts from any year in April and that goes till March of the next year. That is, for this very year that we are standing in, April 2024 was the financial year when it started, and it will be there till March 2025. So that's how we calculate our national income. When I talk about the calculation history, how it was calculated earlier. So if I talk about the earlier days before independence, it was Dadabhai Naoroji who came up with the idea of national income accounting. So the first scientific method, but he was not able to, because he was the pioneer of this, he was not able to compute it scientifically. Then came your Dr. V.K.R.V. Rao. In 1931-32, he was the first time that he scientifically tried to see how we can calculate our national income. And typically there are two parts to it. One is the primary sector and the other one being your secondary sector. So he typically divided the whole economy into two sectors, primary as well as secondary. So that's how the division was done. Okay, moving ahead, you need not remember, what happened before independence. Let's see what happens after independence. That is your National Income Committee, which was formed in 1949. The chairman was Dr. P.C. Mahalanobis. He was the first person who was chairing this committee, which was looking after specifically how to calculate India's national income. After that, in India, the whole calculation idea or the whole task was given to MOSPI, which is Ministry of Statistics and Program Implementation. So there was a department under this, Central Statistical Organization, that was typically compiling the data for accounting purposes. And finally, the survey, whatever the survey was conducted by National Sample Survey Office. This all continued till the year 2018. In 2019, Government of India merged these two offices and they formed a new department, that is NSO. After merging these two, that is National Statistical Office. So now if you'll ask me who is doing the national income accounting thing, it's done by NSO under MOSPI. Now if I talk about the core concept of your national income, Over the period of time, we are actually calculating national income based upon these 4 aggregates. All in all, for your national income accounting, there are 8 type of aggregates. Let's have a look how we can remember the 8. History is not that important, but yes, you should know what is there. At least 5-10 minutes you can give it to that. So if I tell you there are 8 aggregates, let's have a look how. So in the first column, we can either write gross or we can write net. In the second portion, we can either write national or we can write domestic. In the last, we can either write factor cost or we can write market price. So with using these 4 terminologies, using all these terminologies, we'll come across 8 aggregates. Let's have a look how. So we can say it can be GNP at market price or GNP at factor cost. It can be GDP at market price, it can be GDP at factor cost. It can be NNP at market price, again NNP at factor cost. It can be NDP at market price or it can be NDP at factor cost. So that's how you can divide your 8 aggregates. I hope this is also clear to you all. Now, you might be thinking, what is this gross, what is this net, what is national, what is domestic? We don't know how we should be calculating this. So that's where we are going to see what is national, what is domestic, what is factor cost, what is market price in this whole session. Let's have a look now. Before moving ahead, let's see what is depreciation. As so we all know what is depreciation. It is nothing. Depreciation is what? It is the consumption of the fixed capital that we have. Sometimes we use a capital, we use a machine over the period of time. It will get wear and tear. Because of wearing and tearing of a machine, a specific capital asset that we own, that is what you call it as depreciation. Sometimes what companies do is, in this process of depreciation, they know that in the near future they have to buy a specific machine all over again. In this case, they keep certain amount of their money aside for that future expense. And this is what you call it as your capital consumption allowance as well. Sometimes, you will come across depreciation. It might also be the case that, they'll use the word consumption of fixed capital. They can even use current replacement cost. They can also use a replacement of fixed capital. So interchangeably, your depreciation can be used by using multiple words. So this can be one such case. I'll tell you, Satya, we'll go to that. Just wait a few minutes. So this is what you call it as depreciation. Now, the first thing that we read was gross and net. So whenever I know what is my gross GDP or gross investment or gross whatever, if I subtract depreciation from it, I'll reach upon a number that is net. So gross investment minus depreciation is your net investment. That means your gross will always be more than net. So that's how your depreciation is. I hope now you can understand how you will fill your first blank. That is how you will fill gross and net. So what is the difference between gross and net? Gross minus net will come out to be what is depreciation. Very simple. Then comes your factor income. Now what is factor income? See, factor income is an income that is generated by all the factors of payment, all the factors of production units. What are the factors of production units? So there are 4 factors of production, 4 factors allotted: land, labor, capital and enterprise. So whenever we use our land, that actually gives rent. When we use labor, labor gets wage, salary, whatever you can say. When we use our capital, capital gives us interest. And when we use our enterprise, entrepreneur, they use their skills to generate profit. All in all, what are the factors of payment? So all these modes of factors, they produce certain payments, and if I just add them, rent, wage, interest and profit, I'll reach upon factor payment or factor income, whatever you want to say. This is your factor income. All this factor income is used to derive your national income as well. Let's move ahead and see what is transfer income then. As there is a factor income concept, in factor income it's very clear. You give something, you use your land, you'll get rent. You have labor, you have to give them wages. So that means there is certain services, there are certain services that are rendered in replacement of which the payment is being done. Very simple. These are bilateral payment. To and fro thing is being done. But if I talk specifically about your transfer payment, they are unilateral. No exchange of goods and services take place. Your gifts, the donations, the old age or disability pensions, because scholarships, unemployment compensation, here there is no goods, there is no service that is being rendered. There is no exchange of goods actually. It's a one-sided payment. That's what we call it as unilateral payment. But now over here, I want to tell you one thing. If I talk about retirement pension, whenever we say retirement pension, typically your retirement pension is a pension or an amount which was cut from your own salary when you were working, and after you get retired, you will be getting some amount of pension, because for retirement pension the work had already been rendered, the service has already been rendered. In this case, retirement pension is not a transfer income, it's a factor income. Remember this. That also means all type of pensions, they are not transfer, they are not transfer income, they can be factor income as well. One thing. Now, if you remember the first slide that I read for you, it said national income is the addition of all the goods and services produced in an economy, because in factor income there was some goods and services which were being produced, but in transfer income there is none. Thus, we will not add transfer payments in our national income. That has to be very clear. That also means we do not add donations, old age pensions while we are calculating our national income. Our India's national income does not account for all these factors. I hope this is also clear. The next thing is, what is the net factor income from abroad? What is NFIA in short? Net factor income from abroad. So let's have a look briefly about what does this, we have understood this factor income. Now we want to see what is the factor income which is coming from abroad. I just want to ask you one thing. We all know Indian borders. Sorry for the poor map, but then yes, if at all some goods and services, they are being produced inside our domestic territory, we say it is a domestic product. That means these goods and services which is produced within our domestic territory can be produced by an Indian who is living in India or by a foreigner who is also living in India. One thing is clear, the geographical boundaries are defined. So any place which comes under India's domestic territory will be counted under your domestic thing. So whatever income is generated by the goods and services produced within India's territory, that's what we calculate, or what we call it as domestic income. That can be generated by an Indian, can be generated by a foreigner as well. Like, let's take an example of an Air India plane that is there in US, and in US it has in the plane itself there is some tea or coffee being sold. So in that case, because that is an Indian airplane, that goods and services which is produced within that airplane will be counted in India's domestic income calculation. So domestic income will take into account your geographical boundaries, and that's where the domestic word comes into play. The other thing is your national income. Whenever I say national income, as the name suggests, we are talking about nationals. Which nationals? Indian nationals. When I say national, these nationals can be Indians who are living in India, or they can be the Indians who are living in some foreign territory. But one thing is clear, they must be Indians. So for national income, we take into account what Indians are earning, either living in India or in abroad. But when we say domestic, it's like the geographical territory is defined. Now, what is then net factor income from abroad? It means what is the income that our citizens have generated in the foreign territory, and what is the income that these foreigners have got in India. And when we subtract it, that is, when we are going to subtract the factor income which is from abroad minus the factor income which is going to abroad, because foreigners will take their money back to their own country. When we are going to subtract this, this is what we call it as NFIA, net factor income from abroad, this much. And when in domestic income I add NFIA, I get a number which is national income. I hope this is clear. If not, I can explain it via other way as well. But I want your participation. Is it clear? Should I be explaining it some other way? See, we can understand it this way as well. Domestic income. Let's say there was an Indian who was living in India. His income will be added. Let's say there was a foreigner who was again living in India. His income will also be added. Now, if I say national income, what is national income? National income is Indian who was living in India plus Indian who was living in foreign territory. So, his income will be added. Now, if I have to come from domestic to national, how can I come is, I need this in both the side, but here what is required is Indians who are living in foreign territory, and what I don't require is FI. So, what I have to do is, I'll subtract factor income from abroad and I'll add income which is earned by Indians in foreign territory, and this adding and subtracting is nothing but net factor income from abroad. You can just understand it anyways, that's up to you. I hope this is clear. If not, we can have one more example, but then please give me a thumbs up if it's understood. If not, we can have more discussion on this. Next. Now with this, one thing is clear. You might be now thorough with this, that your GDP, your GNP, when I have to go from domestic to national, I have to add NFIA. And when I have to go from gross to net, I have to subtract depreciation, as simple as that. So up till now, what we have read is two things. Going from gross to net, we have to subtract depreciation. Going from domestic to national, we have to add net factor income from abroad. Moving ahead. What is market price? What is factor cost? When I say market price refers to the actual transaction of goods and services. Like, if I am going to a market, I am buying a Parle-G cost ₹10. So 10 is my market price. When I would say, what is the factor cost then? Factor cost is the cost that is there because of the factor income that is being included. What are factor income? Factor income is rent plus wages. After this, interest. And lastly, it's your profits. The four factor income, the four parts of factor income which we have already discussed. So rent, wages, interest and profits. If I am going to add this, just add this much, I will reach upon a number which is factor cost. But then how I can reach upon the market price? See, what happens is, on this factor cost, government usually add taxes. We all know indirect taxes are added. Even when we buy Parle-G, we are giving some amount of tax that is being added. Thus, from factor cost, when we are going to market price, we have to add taxes. Now, one more thing. Sometimes, on this production thing, let's say one day government says that to all the biscuit manufacturer, government is going to give electricity subsidy. Because some subsidy is given on what? On the production thing. The subsidy has to be subtracted. Taxes are going to be added, subsidy are going to be subtracted. Factor cost to market price. What all you have to do? You have to add the taxes, the indirect taxes, and you have to subtract the subsidies. Sometimes together they are being written as net indirect taxes. What is net indirect tax? Taxes minus subsidy. All in all, if I know what is the market price, what I'll do is, from market price, I'll subtract taxes, I'll add subsidies, I'll get factor cost. Any problem in this, Satya? If you feel I should be explaining it again, I can do that as well. But then I want you to tell me if it's clear. All in all, factor cost is market price minus net indirect taxes. Same thing, just here and there I have written it all. You can just give it a reading. If you feel that still you feel that you need more time to understand this, take your time. In the next class we can again revise whatever we have done. So that can be there definitely. But then moving ahead to the next portion. Could you please try to solve this? Which of the following is correct regarding factor income and transfer income? Once again, very good. See, in your factor cost, which comprises of 4 things: rent, wage, interest, and the last is your profits. Rent, wage, interest, and profits. When I am going to add this 4 things, I'll get factor income or the factor cost. In your factor cost, usually the taxes are added. What kind of taxes? The indirect taxes. The subsidies are subtracted, because subsidies, they are given by the government, maybe on electricity, water consumption, some other subsidy might be there. So that will be subtracted. You'll reach upon a number. Factor cost will be indirect taxes minus subsidies. You'll reach upon a number that is known as your market price. That's the key. Or sometimes, cumulatively, consolidatively, they are written as net indirect taxes. That's the key. Anyways, anybody, could you please solve this? Which of the following is correct regarding factor income and transfer income? So factor income and transfer income, they are essentially the same thing. Is it? No, we have just seen they are not the same thing. Factor income includes income which is earned from the factor of production, while transfer income is government aid to individuals or entities. Let's have a look on the other statement as well. Factor income refers to income received from foreign countries. No, that's not the case. Foreign countries, whatever we are receiving, it's the remittance. And because foreign payments we are getting against the goods and service being produced, so you will not say it to be a factor income. Factor income includes salaries, wages, while transfer, your business profit. No, that is also not the correct thing. Factor income is a measure of GDP, while transfer income, your GNP. No, only option number B will be correct. Now just one more thing I want to add over here is, whatever we have read, let's have a discussion on that. We have just read 3 things. E, market price, N, factor cost. When I know gross, I have to go to net. I'll subtract depreciation. I know domestic, I have to go to national. I know domestic, I have to go to national. What I'll do is, I'll add net factor income from abroad. If I know market price and I have to calculate factor cost, what I'll do is, I'll subtract net indirect taxes. As simple as that. Now I want to ask you one question. I am given GNP at factor cost, or I have to find GNP at factor cost. I am given NDP at market price. Can you guys tell me what all should be done? Should I add something? What all needs to be subtracted? That has to be like, you have to help me out in solving this. Tell me. I am given this NDP at market price. I want to calculate GNP at factor cost. Quickly tell me how I am going to reach upon this. So in this case, I know net, I want to go to gross. What I have to do is, I have to add depreciation. Yes or no? Certainly yes. I know domestic, I have to go to national. I will be adding net factor income from abroad. I know market price, I have to calculate factor cost. I shall be subtracting net indirect taxes. Very good. So I hope this is what we have read up till now in the last 20-25 minutes. This is the summary of what all we have read. Moving ahead. National income we have calculated, you know, we have done so much calculation. We actually calculated your GNP at FC, calculated NDP at market price, depreciation, NFIA, everything we have understood. Now, if I just want to tell you one thing, what is your national income then? Like we have actually calculated 8 aggregates, but then national income cannot be all those 8. What is national income? If I have to just add one thing out of the 8 aggregates that we had written, what is national income? It's N at F. You have to remember this. Net national product at factor cost. Aishwarya, for reference book, if you want to start from yourself from scratch, I would say NCRTs. NCRTs will be suffice. And if you want to read it any further, you want to, you know, gain more knowledge about it, then I would say only read topic wise, don't read the full book. For topic wise thing, either you can go for Nitin Singhania or Ramesh Singh. The choice will be yours, but don't read that book cover to cover. That's not, that is required. Anything. National income, what it is? It is NNP at factor cost. What is domestic income then? Domestic income is nothing. NDP at FC. NNP at FC is national income, NDP at FC is domestic income. That's how usually in common parlance we try to calculate national and domestic income. Now just one thing I want to ask is, we know national income, what Indians are earning either in India or in abroad. We know what Indians are doing, how Indians are doing. Then why are we calculating domestic income? Because anyways, domestically whatever will be produced, it will be either by the Indians or by the foreigners, and foreigners, whatever they are producing, they are going to take it away from our country to their homeland. They'll be taking it back anyways, है ना? अगर कोई Indian भी foreign में he or she is working, whatever he might be earning, he'll be sending back to his own family, his own country. That's what the foreigners living in India will also do. Why do you think when we are calculating national income, we are so much concerned about the domestic income as well? When we say GDP, what is GDP? Gross domestic product. All times, at all times, after every quarter, we are concerned about what are the GDP figures. World Bank says 6.6% is the GDP. Wow, how they have reached upon this, or why they are so much concerned about GDP? Because GDP comprises of what the foreigners have earned in India. Tell me. Why? Because Indian government want to know what are the conditions with respect to ease of doing business. How many people can come to India, they can establish their firm, they can provide the employment, because if they are coming to India, if they are able to earn some amount of money, that means they are also able to employ someone. Employment will grow. So that's why certainly we are so much concerned about our GDP figure. We are concerned about the 6.6% growth. We are concerned about even the recently released NSO data, which provisionally speculate that last year we had 8.2% growth rate. But then it's still debatable. Let's have a look what will be the final figures. I hope you can understand what we have read up till now. Moving ahead, we have calculated national income, we have calculated domestic income. You know, all the 8 aggregates of national income accounting which we have seen, we can convert it from one to another. How conversion can be done? This is the key. But then, you know, there are certain critics which says that doing all these things is not a nice idea. There are certain drawbacks to it. There are certain disadvantages of calculating your national income. What are they? Let's have a look. The first is exclusion of non-market activities. Non-market means the gambling activity, you know, the illegal activities, they are not included. You will not be able to catch it. The other thing is, what about the caregiving activities? The caregiving activities like our mothers do, they do not get paid for the work they are doing. And what about, you know, their contribution in the economy? That cannot be calculated because they are not given any income. The other thing is income distribution. We can say that in any country the per capita income is so and so, but what about the inequalities? Whenever we try to calculate national income, we are least bothered about the inequalities that might be prevalent in that area. So that gets missing. The other thing is quality of the data. See, how the data is being collected. It can be there that the smaller pool of data is being collected. Whatever data is there within the eyes of the government, that may not be true. The other thing is sometimes, because Indian economy is informal, highly informal. If your economy is informal, calculating exact data is sometimes a very tricky task. The other thing is excess focus on quantification. You are just focusing upon number, 6.6%. RBI said in this monetary policy, 7.2% GDP growth. But then, when I say 7.2%, I am not talking about the literacy level. I am not concerned about the unemployment rate. So, this mere quantification of national income will not show true picture about the economic growth. It can be there that economic growth is happening, the numbers might be increasing, but at the similar point, your jobs are not creating. That we are going to see in our employment elasticity part. But then, changing of economic landscape. See, we are using the same pattern of national income accounting, but now new models have been added. E-commerce platforms, they are also finding a place in this national income accounting. So that's also one thing that we need to take care of. The other thing is complexity of data. See, India being so huge economy, so many people are there, collecting the data, simplifying the data is itself a tough task, but nowadays it's not that complex. Simply we can use data analytics, AI, data scientists are there. They can actually tell the data, extract the data very easily. So that definitely is there. And to solve this complexity of the data also, certain ministries, they are coming up with their own initiative, like RBI coming up with data mesh. I hope you have seen the recent MPC report. What is this data mesh? It's nothing but a place where all the data will be created. As and when RBI will require any data, RBI can extract the data very easily. So that's what you call it as a data mesh. Anyways, the next topic of discussion is current price vis-a-vis your constant prices. When I say current prices, what are current prices? Current prices are the prices that are prevalent in the market today. On this day, I can buy a Parle-G packet of ₹10. So that's the current price. What is the constant price? When I say constant price, it's the price that was prevalent in the market at the time of the base rate. So what typically India does is, India has selected a base year, and in India the base year as of now is 2011. So 2011 is the base year. When I say base year, whenever we are going to calculate the prices which were prevalent in this base year, I'll say I'm calculating the GDP or any NDP, any aggregate at the constant prices. Let's have a look how. Let's say in 2011, a product was being purchased at ₹10. So let's say 1 unit of that product might have costed, 1 unit of that product in 2011 might have costed ₹10. We purchased 10 products, and that's how the number come out to be 10. So our constant price at that time was 100. What will be our current, just 1 minute. Let's say in 2011, the number of quantity that were produced were 10. The price of each quantity was again 10. So total price, that is at constant prices, were 100. And what will be the total price at current rate? It will again be 100. Now let's say in 2022, 10 years after, the quantity produced was 10. The prices have increased to 20 now. What will be the current price? If I would ask you what will be the current price of the goods and services produced, it will be 200. 10 into 20, 200. Very simple, right? But what will be the constant price? Constant price will remain the same as it was in 2011, because I have chosen this year as my base year. So the total price at the constant in 2022 at constant prices will remain 10 into 10. That's again 100. Yes, you might feel that your GDP has inflated. The total prices have increased. But do you think that price have increased? That GDP had the GDP which has increased, it is because of an increase in your production level or the inflation? You can easily see over here that the increase in your goods and service produced is merely because of inflation that is happening. Let's say in 2024, the goods and services which were produced were 20, and this time the prices remain same. The current prices would be 20 to 20, that is 400. Again, you can see the GDP is rising. The number of goods and services have increased, GDP has also increased. But over here you can see one thing, this time the prices have not increased. That means whatever is the increase in GDP, it's merely because of, definitely because of the increase in the production level. Now, if I say calculate your current GDP using in 2024, it will be 20 into 10, that is 200. I hope this is clear. Any problem in this, please ask. I am waiting for your questions. At least give me a thumbs up if it's clear. Constant price, what is current price, clear? What happens is, generally we try to avoid using or calculating our GDP at current prices, though it's very easy to calculate because back calculation is not there. But if we calculate GDP at current prices, the inflation is also there. The impact of inflation will always be there. So if we want to calculate the exact increase of goods and services produced, what we have to do is, we have to eliminate the effect of inflation, and that's what is done by your constant prices. Fixing constant price, fixing a base year, that's why the fixing of base year is being done. I hope this is also clear. If not, you can just give it a reading. If still you find anything which is tough, we can talk about it in the next class. Now then, what is GDP deflator? See, what is the impact of inflation on the economy? If at all your GDP is rising on the, because of your rise in prices, because of inflation, if you want to find what is the impact, in that case, we calculate GDP deflator. What it is? It is nominal GDP upon real GDP. Now you might be thinking, what is nominal GDP? See, nominal GDP is typically the GDP which is there, like, I hope guys I'm clear, I'm audible as well, right? Nominal GDP is the GDP at the current prices, and the real GDP is the GDP at the, in the base year or the constant prices. Very simple. Whenever I calculate my GDP at the current price upon GDP at the constant price, multiply by 100, I'll reach upon a figure which is known as your GDP deflator. I hope this is also clear. Easy? Let's move ahead. What is national income? We have already seen national income is nothing but your NNP at FC. The same thing is written over here in in just sentences. You can just give it a reading. The other thing is, what is domestic income? We have also seen this. It is NDP at factor cost. The same thing is written over here. Please do give it a reading after the class. Now let's see what is the measurement of national income. How you can measure your national income. So for measurement of your national income, there are three methods. One is the value added method. The next is the income method. And the last is your expenditure method. Whenever I say value added method, which is also known as your product method, I am just concerned about at each stage what is the value of goods and service that has been added. So like, let's take an example again of the sugarcane, sugar and sweets. Sugarcane, sugar and sweets. Sugarcane might have costed rupees 30. Sugar might have costed rupees 50, and sweets, the sweets that were being made out of them, costed rupees 150. Now tell me, what is the total value of products that have been done? Like, you know, we are calculating GDP via value added method. That means I'll get a number which is GVA, gross value added at market prices, because after all these are the market prices that are prevalent. So I'll get gross value added. Tell me, what will be your GVA at market price? So will it be 30 plus 50 plus 150, that is somewhere around 230, yes or no? No. Why? Because this is not the goods and value that has been added. What has been added is, over here what is added is rupees 20. The value of rupees 20 have been added. When we have converted sugarcane to sugar, a 20 rupee value has been added. The other thing is, from sugarcane to from sugar to sweets, what amount of value is added? It is rupees 100. So all in all, 120 will be your gross value added at market prices. That's how you are going to calculate GVA at market price. Once we know what is our GVA, what is gross value added at market price, what we are going to do is, for each sector, let's suppose this we have done for a primary sector. Similarly, we can do it for automobile, we can do it for all the sectors. We are going to sum it up. This is the sign of sum. So when we are going to sum it up, we are going to add it, we will reach a number which is GDP at market price. And once you are able to calculate any one aggregate GDP, you can calculate NNP at FC, you can calculate NDP at FC, that we have already seen. That's how your value added method or product method is being used. Whatever I have told you, it's written over here in lines. Now when I am calculating my value addition, what I should deduct? I should deduct net indirect taxes. I should not add the capital consumption. We should also deduct the raw material consumption. We have not added this rupees 30. So that's what is being said. Finally, the foreign states' net income should also be included. So that's how summation of your GVA at market price you upon at. I hope this is also clear. Next. The second method is income method. We have done the first portion, that is your value added method, the next one being your income method. In your income method, what we are going to do is, we are going to add what are the various factors which are giving us income. So there are 5 factors that you can learn. It is P, R, I, M, E. What is P? P is the profit. The profit can be the dividends. Profit can be in the form of dividends. It can be in the form of retained earnings as well. Some amount of money it is retained by the firms for its future expenditure, for its expansion purposes as well. That is your retained earnings. The next thing is R. R is rent. I. What is I? I is interest. M. M is mixed income. That can be income from other sources, some freelancing work, something like that. So it's your mixed income. And E. E is the compensation which is given to the employees. So E will be compensation of employees. Just an acronym, how you can remember it. So it is compensation of employees. So if I am going to add all these things, what I will get is, whenever I am adding all these things, I will get upon a number which is called as NDP at factor cost. What I will get? I will get NDP at factor cost. And that's what we get in the income method, NDP at factor cost. Now once we get NDP at factor cost, we can convert it into any aggregate that we need. We can convert it into GDP, we can convert it into NNP, anything. So that's how the case is. I hope this is also clear. Any problem in this, please ask. Now one more thing I want to add over here is, in the compensation of employees, compensation can be given in the form of cash, it can be given in the form of kind as well. All the things have to be added. It can be given in the form of bonuses as well. Whatever the name may be, but if it's the compensation given to the employees, that has to be added. I hope this is also clear. Any problem in this, please ask. So that means NDP at FC, if I am going to add all these 5 factors, I will reach upon NDP at factor cost. That is my income method. Last comes my expenditure method. Whenever we are going to see what is there in the expenditure method, it is basically the total value of expenditures that we have made. In my expenditure, it is basically the expenditure that is being done by the consumers like us on the goods and services. We buy certain things, that's our expenditure. It can be the expenditure which is done by the government as well. It can be, some business organizations who are spending something. They can be in the form of investment. Then lastly, it can be net exports, the exports that are being done minus the imports that we are doing. So that's how, if we just calculate all these things, we will get to know what is our expenditure. And when we add all these things, when we see what is our expenditure, we will get GDP at market price. When we will find GDP at market price, simply we can convert it into any national income aggregate. But this you have to remember. Now when we say, okay, one thing we can do is, I'll wrap up over here. In tomorrow's class, we are going to again pick this topic, and then we are going to read it further, because still there is a lot that is left. And let's start it in tomorrow's class afresh. Thank you and have a nice day. But then I just want to give you some time. If you have any query, please ask. Anything that you want to ask? Okay, then let's meet again in tomorrow's class, and we'll discuss it further. Thank you and have a nice day.